Investing with $100 won't make you a millionaire overnight, but it can start a habit that quietly compounds your money for years. This video gives you a practical, no-frills plan you can actually follow today. It treats your dollars like seeds, not fireworks. We'll break it into 5 steps you can repeat with any fresh hundred you find. And yes, you can do this with real money, not a dream. Step 1 is about the person behind the portfolio. Clarify your goal and your time horizon. Without a clear target, every market movement feels like you're chasing shadows. So ask yourself honestly what you're aiming for, and when you want to look back and say, that worked, ask yourself, what are you saving for? A home, retirement, education, or just a bigger cushion for life's surprises? Set a timeline you can actually commit to, even if it's 5, 10, or 20 years. Your answers will shape how you invest and how much risk you can tolerate. Next, examine your money situation. Do you have debt with high interest? Is there an emergency fund you can actually rely on? If not, consider paying down the worst debt first and building a small safety net before you put the $100 to work. Investing is easier when you're not juggling high-interest costs. Step 2 is choosing a brokerage that fits a small starting amount. Look for a platform with no minimum and the ability to buy fractional shares. The goal is to put your money to work today, not to wait for a perfect payday. Also check for fees. Look for zero commission trades and no annual or inactivity fees that eat tiny portfolios. If you can avoid those costs, your $100 can actually stay invested and grow over time. A broker with straightforward terms can keep you from being blindsided by hidden charges. If you're unsure which broker to pick, start with a short list. One that offers fractional shares, one with easy automation, and one that's known for simplicity. Read the basics, not the hype, and try the sign-up flow with fake money if the option exists. The right choice should feel calm, not loud. Step 3 is designing a starter portfolio you can actually hold. The plan here is simple, diversified, and scalable as your money grows. For a $100 start, a practical split is 60% into a broad U.S. stock market ETF, 25% into an international stock ETF, 10% into a bond ETF, and 5% into cash or a cash-like fund. This keeps you exposed to growth, while adding some balance and a tiny reserve for opportunities. What does that look like in real dollars? If you invest $100 today, you could put about $60 into a U.S. total market ETF, $25 into an international ETF, $10 into a broad bond ETF, and keep $5 in a high-yield savings or money market option. You're not chasing a single rumor. You're spreading risk across the globe and across asset types. 2 common choices people mention are a U.S. total market ETF for the 60%, an international broad market ETF for the 25%, and a broad bond ETF for the 10%. Ticking the names helps you map how the pieces fit. If you want to keep it ultra simple, you can choose a single all-in-one fund that covers many markets, but fractional shares let you stick to a clear plan with multiple layers. The idea isn't to chase the hottest stock. It's to own a slice of many places that quietly grow over time. It's about building a habit you can repeat and then adjusting as life changes. Step 4 is about automation and consistency. Make investing automatic so emotion doesn't get in the way. Set up recurring investments that align with your budget and your timeline. Even small, regular contributions matter. If your broker supports recurring buys, start with a modest cadence. For example, you could automate a $25 monthly investment split across the same 4 components, or start with $10 every 2 weeks. The key is to remove the friction that comes from, I'll do it later. The more you automate, the more you learn to trust the process. Pair automation with a simple quarterly or biannual check-in. You don't need to obsess over daily moves. Instead, you look at the bigger picture. Did your balance drift too far from target? Do you need to rebalance by shifting new money into underrepresented parts of your portfolio? Rebalancing helps you keep risk in check. With dollar cost averaging, you're naturally buying more when prices are lower and less when prices rise. A light rebalance annually is usually enough for a small starter portfolio. If you're handier with numbers, you can rebalance whenever the allocations drift by more than a set percent. Step 5 is about tracking progress without turning counting into a doom scroll. Keep it simple and honest. A quick log can show you how much you've invested, the current value, and how the allocations are holding up. Set a tiny milestone. After a year, you hope your balance has grown, not just your deposit. If markets wobble, remind yourself that a pause is not a failure. It's part of the plan for long-term growth. Your job is to keep investing thoughtfully, not to predict every move. Now, a few practical tips that help with the real learning part. First, keep fees as low as possible. Even small fees compound over time and eat into returns. Second, avoid the trap of chasing big winners or trying to pick the next stock that will explode. A diversified, low-cost approach tends to perform better for most new investors. Third, don't overlook your debt and emergency fund. If debt has a higher interest rate than your potential investment return, it's usually smarter to pay down the debt first. The aim is a balanced financial life, not a single nice-sounding number in a portfolio. Fourth, if you have more than $100 ready to go, you'll want to maintain the same mindset. Start with the same plan, just scale the dollars. You can keep the 60-25 10-5 split or adjust as your goals change. The core habit stays the same. Invest early, invest regularly, invest broadly. Let me walk you through a quick, concrete example to make this feel real. You have $100 today. You buy $60 of a U.S. total market ETF, $25 of an international stock ETF, $10 of a bond ETF, and you keep $5 in a small savings buffer. A month later, you add $25 and distribute it to the same assets in proportion to the original split. You're not trying to hit a home run, you're building a steady ladder. Over the next year, you keep investing $25 each month in the same way and keep your $5 cash reserve. If the market dips, you buy more of the same ETFs with new money, which lowers your average cost over time. If the market climbs, you've already set a pace and you're buying less of what's higher priced, still keeping the habit intact. The key is to keep going even when it feels slow. Small, steady steps beat big, sporadic efforts. A habit formed with $100 is a habit you can sustain when life brings bigger sums or when it doesn't. So what's the unconventional edge here? It's not finding a miracle stock or chasing hype. It's building a simple, repeatable system that scales with your money and your life. It's about respecting the power of time and the power of consistency. If you're hearing this and thinking it sounds doable, that's the point. It should feel doable, not exotic. The plan is plain because investment basics, done consistently, work. Before you go, a couple of reminders. Start by cleaning up your money situation. Clear high-interest debt if you can, and ensure you have a small emergency fund. Then, find a broker that fits a small start, allows fractional shares, and has low or no fees. The combination makes it possible to start with real money today. Finally, remember this. Your first $100 is a seed. You water it with $25 a month, you protect it with a simple plan, and you watch how it grows, not how flashy the next rumor is. You aren't chasing lightning. You're cultivating a habit that can become a real part of your future wealth. If you found this useful, hit like and subscribe for more plain language investing and share your plan in the comments. I'd love to hear how you're starting with your own money and what you've added to your small starter portfolio. What's your goal and how soon do you want to reach it? Tell me in the comments below.